All right, good morning, everybody. Market seems to have lost its warm, fuzzy feeling. The auctions didn't go well yesterday. We have more auctions again today. I did mention yesterday, watch the clock, look out for those auctions. We never know, right? I didn't know it was going to be good or bad. I just knew we were going to have auctions and we want to pay attention to those. Small caps down the most, more than 1%, closer to 1.25. NASDAQ less than 0.75%, but still down behind the Russell. Europe, Japan, everybody's down around the world. Hong Kong is down the least, closer to flat. Looking at the markets, uh, we always have that chicken and egg. What came first? Who caused the sell-off, and then did it come back again? We had a poor day yesterday that spread globally around the world. Now we're getting it back. This is nothing more than sentiment, though. At the end of the day, we didn't really get something yesterday, right? It's not like the we didn't have an FOMC meeting. We didn't have an official announcement about rates. This is just the market's temper tantrum. We have more Fed speakers today, although Bostic is going to be in the evening. So unless you're trading Globex in the nighttime, that one's just going to pass you by. On short weeks, like we have, Wednesdays are generally where we would get our crude oil inventories, but on short weeks, we'll end up getting them on Thursdays. So we get a little bit of crude data, but this isn't the typical crude oil inventories that we would normally get. It's actually tomorrow. Anytime we have a short week, this happens. So if you're trading crude futures, today's you're not going to get your 10:30 crude oil inventories. It's going to be tomorrow. We continue to see the 10-year push to the upside back above 4.5%, back above the 10-day, 3-day. When price crosses through uh, the 10 and the 3, this is a surge signal. So we're still in surge. We already had the 3 above the 10. So, if we had been in a strong enough downturn where the 3 was under the 10 and price was under both, then we would look first for cross of price through the moving averages, and then we would look for the 3 to cross the 10. But the move down wasn't strong enough to even have the 3 under the 10 in the first place. So all we needed was price to cross the 3 and the 10. Gold working on that 10, and the 3 is still underneath it. So, gold's been chopping about, has been weak enough now that we started a surge signal. We had price cross through, but we still need that 3 to get on the other side of 10. Then we would have price above 10, the 3 above 10, and we'd look for gold to continue that drive. Yesterday, we never did make it through that R1 level. And like a magnet, we did end up going back to the pivot. Today, the pivot channel is higher than yesterday's pivot channel, completely outside. They're not overlapping or touching at all. And it's a narrower channel, although it's not narrow enough to really classify as, the possibility of a trend day. We've made it to the S1 level, and it looks like we're going to open underneath it, but it's important to consider that we're not open yet. So when we're looking at a gapped market, when we're looking at a gap market and we come into the open, we want to consider how big the gap is, right? And what they'll say with gaps is if it's a small gap when we come into the open, then price is very likely going to close the gap. But how do you define a big gap and a small gap, right? There's got to be some way to quantify how big is too big before we say, well, it gapped so much, it is probably not going to even try to close the gap at this point. One of the ways that we can classify that is by the S&R levels surrounding a floor pivot. And if we open underneath the second support level, then we would say the gap is so big, it very likely won't try to close that gap. But if we open above the S2 level, then we can fall into it and bounce off of it like a support level, and we can see the market attempt to close that gap. So we want to watch as we come into the RTH open, see if we're still above the S2, or even if we rally up and get above S1 before the open. It's much more likely that we'll go up and close the gap if we're above S1. We are inside day breakout, by the way. It's just like it sounds. This is yesterday's price range in the RTH, and we are completely outside of that range because we broke out from it. So we were inside yesterday's price. We broke out of it. This is an inside day breakout. Simple enough. We're still in the range of last week, though, so we're not inside week breakout yet. We've barely just begun to even stretch. But the level to focus on if we continue to move to the downside is this support level 2, which lines up really close with Friday's low. It's not spot on perfect, but they're just a few points away from each other. And we would want to consider this whole area unfinished business. If we start to get too close, it'll turn into a magnet. Price will just go there like a self-fulfilling prophecy. And we would expect at least first touch rejection. A lot of anticipated defense along this zone here. If we consider the move from yesterday, measure the entire range and plot it to the downside, we've got a couple of things to look at. One, we had a double bottom from this low back to this low. Now, double bottoms are supposed to be a bear trap. It's a bullish signal, but it needs to be convincing enough that bears actually jump on the thing and try to run it short. So in a double bottom, what we don't want is for price to come back down and tag that line perfectly. That is not what we want, right? Because how is that a bear trap? We never broke the previous low. We didn't expand below it. Why would anybody try to short it there? So it doesn't make a good bear trap. We need price to go lower than the previous low to trap those bears. The problem with that, however, is how far past the previous low are we supposed to go before we start to say, this isn't a bear trap after all. Maybe we're just bearish and we're going to continue to go to the downside. At some point, there has to be a line in the sand where we say, maybe we've gone too far. For me, that line in the sand is 1236. Now, I'd like to see it reverse somewhere around that 111, what I call the warning center. 111 is generally where a good double bottom or double top turns around and goes back, but it's not the end of the line. If we go past the 111, there's still the 1236. And as long as we aren't closing beyond that level, then this can still be a bear trap if it's a double bottom or a bull trap if it's a double top. So at this point, we still could have a double bottom. We haven't gone so far south that we've turned into, a breakdown or a breakout yet. So there's one piece of it is this double bottom. But then there's just measuring all of yesterday or measuring any one single candle. Technical analysis 101. So we can look at yesterday's candle, plot the whole thing out, and again, mark some projections to the upside or the downside. And we have the same number, the 1236. So even if this wasn't a double bottom, we would still be looking at the 1236 and the 111 to consider how far outside of yesterday's range have we traveled yet? And is this going to continue? Now, we've had a really nice move through the overnight hours. Nice, clean price action. It never really got out of control. This is organized selling at its finest. Profit taking was immediately taken over by new participants willing to step in there. Every time we stopped for profit taking, others were happy to take its place. Everything was clean and neat and organized. But it started to slow down a little bit. After getting some profit taking, we really just digested and chopped about, fell out a little bit. On the next pullback, we still seen people coming in to take their place. So profit taking and then new traders, but we really didn't continue the expansion like we did previously. So things are starting to slow down, which makes sense because we're getting around that 1236. We're now looking to see if we're going to turn all of this around and perhaps get a nice clean cup. And then from the cup, maybe we get a handle. So looking to start building a base and then turn around and come back the other way. If we don't build that base, we could also just V. Either way, we want to start making some higher highs. So we got to break this pivot point, get above it. We need 2 higher highs and 2 higher lows to identify a classic trend or a validated classic trend. You could use something like a moving average. If there was, moving averages on here, you could look for a moving average cross. I like to use price, but you can use a combination of that too. Price and moving averages, whatever, doesn't matter. We can also measure just our own Globex range. So starting at 6 o'clock last night to this morning. This is what I call a failed flag. Now it hasn't failed yet, but that's the setup. So we can measure this area as long as we're staying underneath the 786, then we'll expect this to be the channel that we build and look for a 786 crossover for the move back in the other direction. For that though, I drew the pivot levels in the wrong direction, so we want to draw it the other way. There's our 786. 52.92 is a cog line. This is 52.95. It's pretty close, but that's still the line that we need to get through. This is the pull on the bear flag pull. We're building the flag out now, and I call it a failed flag. If this base continues to go too long, if the flag continues to go wider and wider and wider, because we're not continuing the bearish move to the downside, then the bear flag has failed, and we would expect it to turn and come back the other direction, and that would be the cup that I was talking about. So for me this morning, long above 52.95 for a retrace back up. Struggle with, yesterday's low, which kind of lines up with what we're looking at anyways for that 786. Get through the half back, get back up to the daily floor pivot, and then focus on yesterday's level, RTH high, Globex high, just work our way back up through. We are messing with the volatility trigger this morning, and we're interacting with the 3-week moving average. We're underneath the 10-day. We've got a reasonably decent amount of volume, and we don't see any hedging. We're below the ADR red line, so any move to the upside, we're going to have to deal with that ADR level as well. Then we've got the volatility trigger to deal with too. So this move to the upside that we've been discussing, it's got a lot of overhead pivots, a lot of struggle that we're going to have to work through. Otherwise, a continuation to the downside, if we break our own Globex low, then the target is 52.74. That would be the full ADR. The ADR is the average daily range, ADR. And if you just think about what those words represent, average daily range. It's what price does on a day-to-day basis. It's the normal, typical price over the last 21 days. So if we look at a daily chart and consider what has price done on a day-to-day basis over the last month, from its highest point to its lowest point, what's the average daily range for whatever market we're looking at? And for the ES, the average daily range is just shy of 1%. So the normal average daily move is about 1%. You see, it doesn't have to be complicated with the crazy acronyms and, the fancy market phrases. It's the average daily move. Now, the reason there's 4 lines when we have this average daily move is because if you think about that 1% and where we closed last night, from where we closed, we could move 0.5% higher or 0.5% lower. And in between both of those, we'd have our 1% move. But from the close, we could just move 1% in one direction, down or up. So that's why there's 4 lines. The 2 inside lines are the red lines. They're hard to see with all that noise on there. But these are the 4 lines we want to focus on. So from the Globex open at 6 o'clock, we could move 0.5% higher or lower. It's what I call the ADR half. Or from the Globex open last night, we could just move 1% in one direction. That would be moving the entire ADR in one direction, which is the yellow line. The full ADR is what I often refer to it as in my posts. So if we break our own Globex low this morning, we're going to target the full ADR, which would be really close to the low of last week. That would make it multiple support levels at this 52.75 level. 10-day, 30-minute volume profile throughout the day today, unless we break this Globex low at 52.73. That's that last week's low. Unless we break that low, the volume profile is going to shrink today, but we're still not expecting to see the point of control move yet at all. Right now, the TPO is showing a really nice classic P profile. It's a little built out, but really it's not that bad. That's a good profile. The thing about a classic P shape, if you were to look up market profiles, classic P shape, it's considered bullish. But in the textbooks, they really only consider the P shape having been made one way. And I think that's just a failing of the books. In the books, they'll talk about how a P shape is formed by a market that maybe when it came into the open, rallied hard, fast, and then digested for the rest of the day. And it built that classic P shape, and you get the volume profile, point of control in the upper part of that P. Well, that's not the only way that a P shape can be developed, right? You can have a market that was trending, and then it came into the open, and it based there, and then it fell into the later part of the day, and the profile is still going to show, all that accumulation and sideways price action through the day when we chopped about. It'll have the point of control up in that area, and then we'll fall out of it. So a classic P might be considered bullish in the textbooks, but you still have to think about how it was formed. And then, of course, this is a 10-day profile, not just a single day. The takeaway right now is that the point of control isn't going to move anytime soon. It is still acting as a resistance overhead, and it's on the cog line 53. Well, never mind. That's not a cog line. Cog line is 53.32, so it's above this point of control. We don't have to worry about it at this point. But any discussion of a rally is going to have to also deal with this point of control. You can see we were interacting with it Friday and then again Tuesday. So it's there, price is responding to it. So yesterday we hit the TPO, just cut right through it really like it wasn't even there. We also made a new one. So we have a VPOC based on Tuesday's price action. If we make a move to the upside, 53.25 is yesterday's point of control. It's also really close to this 10-day point of control. There's just so much volume, so much old trading activity at that level that any move to the upside is going to have a real struggle to get through that zone. Looking at what we've done for the week, we're still inside the boundaries. This is how far the market is expected to move by the end of the week. It's supposed to stay inside this box. So we could expand to the upside into 53.76 or expand to the downside into 52.64. But that's really about as far as the market should move this week. Now, every market's got its own history with the expected move and whether or not it respects that expected move. The S&P has the most accurate expected move out of all of the products. That's because it was the only one that had 5 expirations in options for a long time. Now, after a lot of experiment, they've spread that out into the other indexes. But when we first got weeklies, the S&P was the first to do it. When we first got 3 expirations a week, Monday, Wednesday, Friday, the S&P was the one. And then one for every day of the week, the S&P was the one. This is always the one they experiment with. It is the most liquid, the most accurate expected move. And so when this is breaking outside of its box and closing outside at the end of the week, I mean, it happens once in a while. It's not a big deal. 8 out of 10 of closing inside this box is what we would expect. On any other market, 7 out of 10, because that's a 1 standard deviation, right? 7 out of 10, 70%. This is what it would look like if we closed outside the box to the upside on a Friday. We get multiple weeks of that, and it starts to demonstrate how the market makers are getting things wrong. They're mispricing volatility, because that's where these levels come from. So 2 weeks back to back where we closed outside the box, 1 week where we actually did what we were supposed to, 2 other weeks where we closed outside the box. If it's supposed to be 8 out of 10, we've got 4 weeks right there where we're not doing what we should. So the market might not be pricing in the volatility correctly, but we still want to pay attention to this as a signal or a warning. There was actually 3 weeks. So that's 5. We don't even have to count back any farther than that. That's a 50-50 coin toss right there. I mean, I can do better than 50-50 flipping a coin. So what this is telling us is don't use, the weekly iron condor strategy, and don't put on trades that need price to stay restricted, right? The likelihood that we're going to stay inside this box is low right now. Expectations are still pretty high for an outsized move in the market. That's what we're looking at here is skew. Skew can represent a lot of things, but just to keep it simple, it's representing the trader's expectation that the market could make a big move. When the trader's expectations are high, the skew is high. We're still above the 10-week, but moving back towards it. We spent most of 2024 above 2%. So we're still not back into our regular rhythm yet. We started to get into it and fell back out again. Now, we've been holding above the 10 for most of the last few years, right? 2024, 2023, we got below the 10 for, some of that bear market. But for the most part, we tend to stay above that 10. Looking at what we've done for most of 2024, staying above that 2%, that was a good run. You look back, it's been a while since we've had a run that lasted for that long, right? From October, well, call it November, when we got QRA, all the way up to April. So that was a really good run before we actually dipped back down below zero. Compare it to anywhere else. This comes up short. That comes up short. It's been a while, right? Since we've had such a consistent, persistent run without getting below that 10. So we had a good run. It's very likely the market's still going to digest a lot of this move. Even if we don't fall back out and cross below that anchored VWAP, doesn't mean we can just that we can't just sit here and chop about, because we can. And if we don't start getting some direction out of the Fed, that's very likely what we're going to end up with, is that we're just going to chop about, not really sell off all that much. We're not looking to go back to 5,000 for an example, but we're also not really going to be expecting a continuation. The market is going to need a new catalyst, something that'll kick the market into high gear, get us moving to the upside again. The market won't stay sideways like this forever. Especially if it's waiting on something, it's going to get its data and make the move. But what is the next something, right? That's kind of what it comes down to. We got some job numbers coming up. I mean, really, that's the biggest thing, is we've got some not just the typical job numbers of today, but non-farm payrolls is coming. Some jobless claims tomorrow. A lot of data coming out of Japan tomorrow night. So we've got a little bit of data, but none of these really stand out as the big data point that might change the market's bias and get us moving again. But that's what we're looking for, right? That we need some sort of existential shock to the market, get it out of this sideways. Just keep in mind, nothing's changed yet, right? They've lost that warm fuzzy feeling, but we haven't had policy change. We haven't had anything yet. It's just the market's perception of the Fed that's chipping their teeth with the same old message. Semiconductors are down this morning. China ADRs, nat gas, airlines, regional banks, Bitcoin, gold miners, cloud computing. It would almost be easier to say what's up this morning rather than what's down. But if we're looking for that falling tide to drop all boats, we've got it. It looks like just about everything is down this morning. Nothing's up except the VIX. The VIX is up 14% over the last 5 days, 8.5% just in the overnight. The cumulative volume still looks good, by the way, and it doesn't matter what you have at the top. This cumulative volume isn't looking at your market, right? So we could put anything up here. It wouldn't change that cumulative volume. This is looking at the NASDAQ, and not the NASDAQ 100. It's the NASDAQ composite. It's looking at the NASDAQ, and it's looking at the total volume of all of the companies in there. on TradingView, you actually have a better version of that. On Thinkorswim, you can't necessarily point it to a particular name, right? Like you can only do one name, but on TradingView, you can do all the US markets. So here we've got the NASDAQ composite and the CBI pointed only at the NASDAQ, kind of looking for divergence. Down below here, I just loaded the CBI. If we open it up, we can choose all US markets. And then we can compare that with the NASDAQ, the S&P, whatever we want to look for divergence. But if we look at all markets, cumulative volume still going up. So, you know, we had that move in the S&P yesterday, the NASDAQ to the downside. Cumulative volume is still increasing. I think I broke it. So it's still increasing. It didn't register that pullback from yesterday. We want to be watching for that this morning, see if it's going to turn down or not. Cumulative volume. All right, with those China ADRs being down, we got BABA with a nice gap, inside day breakout, inside week breakout. Baidu also same gap out. PDD, JD. Then we've got the MAG 7. Been rearranging my charts. I lost it. So far, we're inside day breakout, or we don't have an inside day breakout on Google and Meta. We're still inside the range, but just barely. Apple's up this morning. Nvidia's up again this morning. It's another gap up into 1147. Everything else is near its yesterday's low. So we'll be looking for it to find support on yesterday's low or not. See if it's going to get that rebound. We really need to see that 10-year pause in this move if we're going to see any sort of reversal in the markets. Thinkorswim's had a problem with TNX for a little bit, so I keep using this 10 years future, but it'll work. TradingView doesn't have a problem with TNX right now, but Thinkorswim sure does. Anyways, we're focused on this bit of a scoop pattern here. .5 is kind of a psychological level, line in the sand, and we're above that. So market's got that drama to deal with. This really large candle here is the one we want to focus on for the halfback. It's 4, 5, 5, 5. And we're above that now. So it's not, candle isn't closed yet. So it's not confirmed, but we're starting through that breakout right now. So we want to see this calm down, maybe get back below that 4.50. You see the move that we got yesterday in bonds. This is the kind of drama that needs to stop. Not only do we want it to not fall, but we don't want it to fall this fast. Right? So big move from yesterday. We're not seeing the rebound yet. In fact, we've sold off even more from where we closed at 90.07. We're at 89.69. Now, since we have this really big candle and it's yesterday's candle anyways, we go ahead and measure that out. You can see that we made it underneath the 1, 2, 3, 6. So this is a breakout that we expect to have legs. But that was a really big move from yesterday. So a little bit of a dead cat bounce or mean reversion wouldn't be out of line. So we need bonds to calm down. The 10-year kind of back off, get back below that 4.5. And right now, everything is down. So, you know, it won't be hard to spot if that changes. Be looking for that rising tide, but it's going to have to come back to the news, right? Who did it? What's it going to take? And if you look at what we have on the table, it's really not a lot of economic news that could do it. So unless one of the Fed speakers goes out and ignites animal spirits, then we're looking for another sideways day. Looks like we're starting to come out of that base that I had mentioned earlier. So we want to see a 786 cross. Depends on where you start the drawing. If you want to just take it to the high to the low, it's Globex that I measured here. Okay. All right, everybody. Be careful, be safe, watch the clock. You got auctions again today and got Fed speakers.